Hi everyone, welcome back to lecture 3, part 2. And what we've discussed in part 1 was the use of journals to actually record the initial uh, book of record for transactions, which we call journalizing from the source documents into the journals and then subsequently posting it to the ledgers. We've talked about the different types of journals, the general journals and the special journals. And also we discussed a little bit about the need for subsidiary ledgers in addition to the general ledger. What we want to do now in part 2 is to discuss a little bit about once we have all these accounts, once we have posted entries into the accounts, how do we determine the relevant balances so that we can then use this to prepare the financial statements? And we will also discuss a particular process and a document that we use called the trial balance, which is a checking device, a control device that is used to check whether the accounting equation has been met, the duality principle has been met just before we prepare the financial statement. So we will look at closing entries and the trial balance. Now, first let's look at the closing entries or the balancing of accounts. We've actually discussed the T accounts and as I mentioned before, the T accounts has two sides, the left-hand side and the right-hand side. And the left-hand side corresponds to debit entries and the right-hand side corresponds to credit entries. So you're looking at this example of Sam the cleaner, if you remember that example. And we've posted all the transactions into the cash at bank account. And if you look at the debit side, there is 3 transactions, and the credit side, there is about 4 transactions. So what we need to do now is to calculate what is the balance in the cash at bank account. What is the balance that we will report in the financial statements later. So I just want to show you the process, the procedure, how we do that, and how we write or document the calculation of the balance. Well, the very first thing that we need to do when we have a T account with both sides, with entries on both sides, is to total up both sides. So we total up the debit balance, the debit entries. That comes to about 31,750 pounds or dollars. And on the credit side, we add up all the credit entries and we arrive at 19,150. So what would be the balance here? I mean, the debit side represents all the additions, all the increases, and the credit side represents all the decreases. So at the end of the day, is there a net increase or a net decrease? So you just take the increases less of the decreases. You take the debits less of the credits. And you will have the debits exceeding the credits by 12,600 pounds or $600. So that's the first thing that you do. But how do we document it inside in the T account? So the principle here is that the T account being having both left and right hand side, we have to make sure that both sides balances. So we total up the highest amount, whether it's debit side or credit side, onto the at the total section. So on the debit side, there will be 31,750. So on the credit side, they should also be 31,750. So what that means is that the debit side has an excess of 12,600. So we show that there is a debit balance by filling up the difference on the credit side with the total with 12,600, and we call that balance carried down. So that is the balance of debit entries more than the credit entries, which we now carry forward or carry down to the next accounting period. So in the next accounting period, we will have therefore a debit balance of 12,600, which we will describe as balance brought down. So this is the process by which we calculate or determine the relevant balances, whether it's debit or credit balances. Right? Of course, this is some may find this to be rather complicated way of doing things, but this is just to show that both sides are in balance. And of course, there are other alternative ways of doing this. One easier way is actually do what is called a balance format or a 3-column account format, which is shown here. Which is as far as the transactions are concerned, they are the same transactions. But what we do is, if you look at line by line, we actually calculate the balance immediately. So after the transaction on the 2nd of January, where Sam drew contributed capital of 30,000, which increases the cash, and therefore you debit the cash, you would have a debit balance of 30,000. So on the next day, 3rd of January, when Sam took out cash to actually buy some cleaning equipment, he would have reduced his cash, credit his cash, and you would then have a balance of 16,000. So you go on, in every transaction you determine the balances on the far right column. So this is, I suppose, an easier approach to calculating the balance, and at the end of that month's transaction, immediately you will know that you have a balance of 12,600. So this is a 3-column format which you can use. So you can use either method. It's just that some people are quite familiar with using the T account rather than with using the 3-column or balance format. But either one can be used. Now let's move forward to discuss another interesting thing with regards to the accounts in the ledger. If you recall, in the second week, last week, there is a slide that I showed that talks about the period concept, which is a concept by which we say that the life of a business is ongoing and is unlikely to end. But what we do is that because we want to have periodic reporting, we want to have a regular reporting of the performance of the company or the business, we divide the company's life or the business life into arbitrary time periods. Normally, this time period is for 12 months. So what happens is that for each of at the end of these periods, we report the statement of financial position, which is represented by asset equals to liability plus owner's equity. So at every point in time, we take a snapshot of the company's or the business financial position. So these balances, these ledger accounts that represents the assets and the liabilities and owner's equity, are carried forward every period. Okay, so they are continuously kept. The balance is continuously accumulated over the periods during the life of a business. And as long as there's balance in there, we continue to carry those accounts forward. So that's the nature of the balances that represents assets, liabilities, and owner's equity. But if you look at the profits are determined for each period of time. And for each period of time, we calculate the revenues and the expenses during that period alone, and we determine the profit. So if revenues exceeds expenses, we have profit. If revenue does not exceed expenses, then we have a loss. But the point I'm trying to make is that the amounts of revenues and expenses are always calculated or determined for one particular period by period, right? But for the statement of financial position, the balances in the assets, liabilities, and owner's equity are continuously accumulated over the life of a particular business. So this gives rise to an interesting point of view of the accounts. So if you look at the accounts that represent assets, liabilities, and owner's equity, they are what we call permanent accounts, whereby the balances are carried forward. All right. So whatever transaction you have for this year, we calculate the balance. We bring this balance forward to next year and add next year's transactions, and then we carry it forward to the following year and add the following year's transactions, and it goes on and on and goes on. So it's accumulated throughout the life of the particular business. And these accounts, these balances are then reported in the statement of financial position as balances as at that point in time. So these are called permanent accounts. But if you look at the revenue and expenses accounts, you realize, as I mentioned just now, they are not permanent accounts. They are accounts that are created just to record transactions during that particular period. We call them the temporary accounts. So for example, you have expenses, you open your expenses account, and during the year, the expenses accounts will accumulate all the expenses incurred by the business. So in this example, they have incurred $9,012 worth of expenses. It's on the debit side. And for revenues, the same thing. They open the revenue account for that year, and they accumulate all the individual transactions during that year, and they arrive at a total cumulative amount of $10,250. So these balances are for that particular year. Now, at the end of that year, when we want to determine the profits and losses, what we have to do is to clear off all the revenues, to transfer out all the revenues, excuse me, from the revenue account, and transfer all the expenses from the expenses account and move it to the profit and loss summary account, sometimes called income summary account. So what we do is that if you look at the expenses account, to clear off all the debit balances, we credit that account and debit the P&L summary or income summary account. For the revenue account, we would debit that account to clear off all the credit entries there and credit the P&L summary account, right? And then we calculate the profit from there. If the revenue side exceeds the expenses side, you would have a profit, and that profit in this case is $1,238. Now, that P&L summary itself is also a temporary account, because after calculating the profit, that profit again is transferred from the P&L account to the capital account of the owner. So how do we do that? Is we debit that P&L, we put an entry into the debit side to take out that balance and put it into the capital account. So then the P&L summary would disappear, the expenses accounts would disappear, and the revenue account will be cleared off. All right. Another account that we also will treat as a temporary account is the drawings account, which is also maintained for one particular year alone. So remember the drawings account, if you draw money from the business, it will be a debit entry into the drawing account. So the account would have a debit balance. So you transfer all that debit balance from the drawing accounts by crediting it and transferring it to the debit side of the capital account. So the capital account will be a permanent account. It's a permanent account. It's part of owner's equity, and it will be reported into the statement of financial position. Meanwhile, the profit and loss that is calculated in the profit and loss summary will be reported in the income statement for that particular year to show what is the company's performance. So these are the different types of nature of accounts, and some accounts will be closed, some accounts will be carried forward permanently over the life of the business. So there you have it. We have a series of different types of ledger accounts. We have assets, liabilities, and owner's equity, owner's capital. which are permanent accounts which we carry forward indefinitely. Revenue, expenses, and drawings accounts are temporary accounts which we open just for 1 year to capture the transactions during the year, and we close it off, and at most of these accounts balances will flow into the capital account. Now, so we use these accounts, these ledger accounts, to prepare the statement of financial position and the income statement. Now, remember, I will draw you back to the previous slides where I said that all these ledger accounts are stacked one after another, and we can't really see that whether the duality principle has been met. Okay. Yes, we do have the journals to make sure that each entry, has got at least equal debits and equal credits. But sometimes errors may happen. Sometimes we may have postings in the wrong account, or we may make mistakes in terms of posting into the general ledger. So we needed a mechanism to check again that the duality principle, the accounting equation, is constantly in balance before we prepare the financial statements. This document that we use is called the trial balance, right? And the trial balance essentially is an extraction of all the balances in all the ledger accounts. We put them into one summary sheet, and we indicate for each item, let's say bank or capital or motor vehicle, we will put the balances in the respective columns, whether it's debit balance or the credit balance, and we total it up to make sure that the debits equals to the credit. If the debits equal to credit, we are happy. All right. So we think that our transactions have been properly done, and from there, from this trial balance, we can extract the balances for the preparation of the various reports. So I want to talk a little bit more about the trial balance. So the trial balance is a method of internal control. It's to basically check the arithmetic accuracy, the mathematical accuracy of the ledger balances, and whether we have posted all the transactions in the right manner in the appropriate side of the ledger. So the trial balance allows us to actually detect any particular errors that may have occurred, right, because of the volume of transactions that we have. Excuse me. And besides detecting errors, the trial balance is also used as a source to extract the balances for the production of the financial statements. Now, as I mentioned just now, one of the important uses of the trial balance is to detect some of the types of errors. So here are examples of some of the errors that we can detect. Some are arithmetic errors, calculation errors, summation errors, addition errors. All right. Some are posting errors that we would maybe have posted into the wrong account, or we have wrongly posted the amounts. Maybe we have posted too much on one side and not enough on the other side. There's also extraction errors as well. So these are some of the errors that the trial balance may be able to detect. But we have to remember, if you had debited and credited the right account, but both sides the number is different, and therefore the debits and credits still balance, then we may not detect some of these errors. Okay, so we have to bear in mind that this is not foolproof either, but it's still a good control process. So there we have a discussion about the need to do a closing entry, a balancing of the accounts, especially if you're using a T account. And then we discuss a bit of the nature of various types of accounts. Some are permanent accounts, which is carried forward indefinitely over the life of a business, and the balances are accumulated. We've talked about temporary accounts, which is normally referring to revenues, expenses, and drawings, and these are only to record transactions for that particular year, or that particular period, and for after that year, after we have finalized the accounts for that year, the balance will always be zeroized and transferred eventually to the capital account. And finally, we talked about the need to have a control document such as a trial balance to make sure that the accounting equation is in balance, the debits equals to the credits, and our duality principle has been met. And the trial balance is also used as a source for the preparation of the financial statements, which is the next topic that we want to look at in part 3 of this lecture 3. So I'll see you back in part 3.